Strong U.S. annuity sales have attracted new entrants to the marketplace, and new AM Best analysis is showing a shift in reserve profiles with increased levels of asset risk as measured by Best Capital Adequacy Ratio, or BCAR. Here to discuss the report is Stephen Vincent, Associate Director, and David Lopes, Senior Industry Research Analyst with AM Best. And Stephen, BCAR is also not the same as the NAIC's risk-based capital system. What do you see as the primary differences?
Well, while the platforms are similar between the two, with common bucketing of key risks and allowances for non-correlated risks, I see the purpose as the primary difference. RBC is intended as an indicator of solvency. It's not intended to be a measure of financial risk. The BCAR, on the other hand, is an indicator of the strength of the balance sheet, leveraging a value at risk methodology that can differentiate a balance sheet's ability to withstand increasing risk in the tail of the distribution. Also, AM Best's analysis of the balance sheet, and more broadly the financial strength rating and issuer credit rating, are forward-looking, whereas RBC is more backward-looking.
The BCAR is not the sole determinant of balance sheet strength. How does your analysis illustrate this?
As per our methodology, there are many other quantitative and qualitative assessments of the balance sheet. Generally, we look at topics such as ALM, financial leverage, quality of assets, to name a few. More specifically, several assessments are impacted by the growth in asset-intensive reinsurance, for example, such as liquidity and the use of reinsurance.
David, the report notes that annuity growth is attracting new entrants into the market, some with extensive investment expertise in private credit and asset-backed securities. How is this market rush impacting average industry BCAR scores?
So the influx of new entrants, especially those seeking annuity growth that are looking to leverage higher yield and more complex assets such as private credit and structured securities, is applying a downward pressure on industry average BCAR scores, as noted by the 2024 decline. The shift is structurally lowering scores by increasing asset risk and capital intensity throughout the industry. This actually reflects a change in business model and also a risk profile, but not necessarily a capital deterioration overall. And it does imply that there is a greater sensitivity to market stress and capital buffers at its margin.
Thank you, David. Stephen.
Thank you.
Thank you.
That was Stephen Vincent, Associate Director, and David Lopes, Senior Industry Research Analyst with AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.